Welcome to our deep dive on mortgage forbearance. In this video, we will explore whether forbearance is a helpful short-term solution or a risky long-term decision. We will walk through how it works, its benefits and drawbacks, repayment traps, timelines, and practical decision strategies, and we will close with key takeaways. Let's begin. First, we will define forbearance and why it appeals to homeowners. Next, we will discuss the catch, how repayment actually works. Then, we will map out timelines and waiting periods that can affect refinancing. After that, we will go through a step-by-step decision framework and expert insight. Finally, we will highlight hidden risks and finish with quizzes and takeaways. Before we proceed, please note that this video is for educational purposes only and does not constitute financial advice. Mortgage rules and lender policies can change, and individual circumstances vary. Consult your lender, servicer, or a qualified financial professional for guidance tailored to your situation. Now let's define mortgage forbearance. Forbearance is a temporary agreement with your lender or servicer to pause or reduce mortgage payments during a period of hardship. However, it is not debt forgiveness. Interest may continue to accrue, and missed payments must be repaid when the forbearance ends through a lump sum, a short-term repayment plan with higher monthly payments, or a loan modification that restructures the debt. Additionally, refinancing can be restricted for a period after forbearance. Next, let's examine the appeal versus the catch. The immediate benefit is preserving liquidity. You reduce or pause payments and avoid immediate default, maintaining your emergency fund. The catch is that the deferred payments do not disappear. Interest may accrue, and the repayment often comes due as a lump sum or via a short, higher payment plan after forbearance ends. You are trading short-term cash protection for potential constraints later, including refinancing restrictions and waiting periods, even if you only used forbearance briefly. Moving on, visualize the journey. The timeline begins when hardship starts and you request forbearance. During the active period, payments are paused or reduced, while interest may continue to accrue. At the end of forbearance, you face a decision point. Repay in a lump sum, enter a short repayment plan with higher monthly payments, or pursue a loan modification. After that, many lenders impose an operational waiting period, often measured in months, before you can refinance or access other credit products. Eligibility can gradually return depending on the specific lender and loan program. Now, let's structure a practical decision framework. Step 1. Clarify your hardship duration and income gap. Step 2. Evaluate your emergency savings and quantify how many months of payments you can cover. Step 3. Call your credit card and utility providers first to request relief, as their programs can be less restrictive than mortgage forbearance. Step 4. If savings are insufficient, request mortgage forbearance from your servicer and obtain written terms. Step 5. Choose a realistic exit plan, lump sum, short-term repayment plan, or loan modifications. Step 6. Align your decision with refinancing goals and any waiting periods that might apply. Step 7. Monitor escrow for taxes and insurance so that shortages do not create unexpected increases later. Next, consider the 3 primary repayment paths. First, the lump sum option requires paying all missed payments and any accrued interest at once when forbearance ends. Second, a short repayment plan spreads the missed amounts over a limited number of months, which increases monthly payments temporarily. Third, a loan modification may extend the term or capitalize the missed amounts into the loan balance to reduce payment shock. Refinancing may be possible later, but many lenders impose waiting periods that can delay access to lower rates or home equity. Throughout, interest often continues to accrue, so confirm all terms in writing, ensure clarity on credit reporting, and keep thorough records of your communications and statements. Meanwhile, let's compare using savings to using forbearance. Using savings is typically cleaner. You avoid deferred debt, you do not trigger forbearance-related waiting periods, and you reduce the chance of servicing errors. This is most appropriate when the hardship is very short, and savings can comfortably cover it. By contrast, using forbearance preserves liquidity when savings are insufficient or the duration of hardship is uncertain. However, you may face a lump sum or a steep short-term repayment plan afterward, and your refinancing options can be limited for several months. Next, let's review illustrative waiting periods. Conventional loans may require a waiting period, often several months, depending on lender policy and whether the account is current after forbearance. Government-backed programs vary and depend on program guides and servicer rules. Access to home equity is often restricted until a history of on-time payments is reestablished. Because policies change and differ by lender and loan type, verify the current criteria directly with your servicer or lender. Now, be aware of hidden risks. Your credit file may show forbearance-related notations, which lenders can see even if you were not reported late. Servicing errors can occur, including misapplied payments, unclear statements, or escrow issues. If escrow is underfunded during forbearance, taxes and insurance adjustments can increase payments later. Waiting periods can narrow your refinancing window, potentially causing you to miss lower rates or equity access. Finally, the sense of relief during forbearance can obscure the scale of future obligations, so it is vital to plan your exit early. Let's test your understanding. Which statement best describes mortgage forbearance? Option A, a payment vacation that forgives missed amounts. Option B, a pause or reduction in payments, with missed amounts due later. Option C, a permanent interest rate reduction. Option D, a program that guarantees immediate refinancing. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Forbearance is a pause or reduction in payments, and the missed amounts remain due. It does not forgive those payments. Here is the next question. When is using savings typically better than entering forbearance for a short hardship? Option A, when savings comfortably cover the gap without jeopardizing essentials. Option B, when you want to refinance immediately after. Option C, when you have no emergency fund at all. Option D, when your servicer offers a lump sum only. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is A. If your emergency savings can cover the short hardship without compromising essential stability, using savings is usually cleaner and helps avoid later repayment shocks and waiting period restrictions. Next, let's consolidate key points. Forbearance protects liquidity in the short term but defers the obligation. Repayment shock is a real risk without a clear exit path. Even brief forbearance can delay refinancing. If the hardship is short and manageable, using savings is often preferable. Always document terms in writing and maintain records. Contact credit and utility providers first, as their relief may be less restrictive. Finally, should you use forbearance? If your savings can cover a short hardship without jeopardizing essentials, that is typically cleaner and avoids later constraints. If your savings are thin or the hardship duration is uncertain, forbearance can be a bridge, but you must plan your exit early and confirm terms in writing. Expect possible waiting periods before refinancing. Monitor escrow and credit reporting closely, and consult your servicer or advisor. Before we close, thank you for watching. If this video helped you, please like, share, and subscribe. Tell us in the comments how you are approaching the forbearance decision, or what questions you want us to cover next. See you in the next video.